G'day, Binanceans, and welcome back to this week's Binance Beach. It is great to be back. It's been a few weeks since I did an episode. We've been busy with a bunch of stuff, and I've been off as well. So we've had we've had Ollie and Kai cover last week's ep, but I am stoked to be back and talking crypto tax in your self-managed super funds. I'm joined by Will from Koinly, mate. Thanks for coming on the show.
Hey, thanks, Liam. Hiya. Thanks for having me.
We'll be talking, first of all, we'll run through a bit of an intro of what a self-managed super fund actually is in Australia, how they work, and then we'll run into the crypto tax implications of that. So if you're looking to potentially hold digital assets in your self-managed super, then this is going to be the episode for you. If you've already got assets in your self-managed super fund, then maybe this will help you understand the tax implications and how that might play out over time. We'll jump into it. Will, mate, what exactly is a self-managed super fund? Let's start with the basics. What is an SMSF?
Awesome. Thanks, Liam. Well, the self-managed super fund, or SMSF, is basically a DIY super fund. So instead of a big institution managing your retirement savings, you become the trustee. You're making the investment decisions. So the main difference between that and a traditional super fund is your control and your flexibility. So with traditional funds, you have to pick from a preset kind of menu of options. Whereas with SMSFs, you're building your own strategy. It's around your goals, your risk tolerance, and your interests as well. So that's kind of where crypto comes in. But there is a trade-off. Like with that freedom, there comes a responsibility. You need to stay compliant with the ATO rules, which are pretty strict. You've got to keep your records as well and arrange annual audits. So there's a few steps to take.
This seems to be a big trend in Oz at the moment. I'm seeing a lot of people talking about starting or their work on their SMSFs, and it seems to be a part of broader investment culture rising in Australia as well. I think particularly down under. I was looking at some data the other day, and the number of retail investors on the ASX continues to climb. Obviously, we've seen enormous growth as a crypto business at Binance, and I know that the other exchanges locally as well are seeing huge user growth. So there's definitely a strengthening of the investor culture in Australia. But why are more people flocking to self-managed super funds specifically?
Good question. I think a big reason more Australians are setting up SMSFs now is that they want more control over their finances and their investments. Like people like having that freedom, to decide exactly where their retirement money is going to go, whether it's into shares or property or crypto. We look at some of the ATO stats and they're quite revealing. SMSFs have grown about 11% in the last 5 years. So that's around 27,000 new funds each year. So, and altogether, this is mind-blowing. SMSFs now hold 25% of Australia's total superannuation assets, and that's about 990 billion in Australian dollars. So it's a huge share of the retirement savings system, and it kind of shows how much confidence people have in managing their own money, and the performance helps as well. We've got, I think it was the University of Adelaide that said they found that SMSFs outperform traditional funds by 1.2%, give or take, every year over the last 5 years. And that doesn't sound like much, but that does compound over time, adds up, especially when we're talking about really kind of quite large long-term retirement savings. So I reckon Australians are kind of turning to SMSFs because they offer the control and the flexibility, the potential for stronger returns, and they also give the people the ability to kind of shape their financial future on their own terms. So it's kind of a hot topic.
Yeah, absolutely. And I guess, particularly over the last 10 years, I think we've seen the rise of the informed retail investor, right? Like news doesn't get distributed through traditional media channels, right? Everything, particularly in the digital asset space, goes out on Twitter. And so you can have access to as much data and as much information and news in real time as a professional investor, as a retail investor. And so that's empowered retail investors who are, I guess, go-getters and want to take control of their own funds and as a result try and deliver outsized returns. They've been empowered to go ahead and do that in general. So it's an interesting parallel there. We're seeing a heap of headlines with crypto and digital assets starting to enter the self-managed super fund space. What's driving this trend, and what can you tell us about the way people are using their self-managed super funds to invest in crypto?
Great question. Yeah, I mean, crypto adoption is mainstream now. I think we can all agree. Around 31% of Australians are owning crypto or have owned. It's become, another asset class in its own standing. It naturally finds its place in SMSFs. And I think it's fair to say the infrastructure is catching up as well. Like, we've got major exchanges now offering an SMSF friendly platform, right? With built-in custody, reporting, compliance, and all of the infrastructure that comes with it. And despite the volatility, if we look at Bitcoin's long-term returns, they've outperformed most traditional assets over time. So stocks, bonds, and commodities as well. So I think trustees see crypto as growth and a diversification play in their retirement mix. So it kind of makes sense to mix it in.
And what's the demographic of that look like? Is it younger people who are starting crypto SMSFs, or is it spread across the board?
It's kind of spread across the board. Yeah, I mean, we look at the majority of SMSF holders right now. Age-wise, they're about 45 of age plus, but we are seeing an increasing number of kind of millennials and Gen Zs getting into the space as well. People aged 35 to 44 make up about 37% of the new SMSF setups, even though they're only about 12% of total members. So we are seeing kind of a convergence happening. We've got younger tech-savvy trustees entering in.
I guess that's the point, right, at which your retirement gets close enough and your desire for tax efficiency kind of hits in your probably in your 30s. You're starting to look at your tax bill, when you're a little further in your career and you're earning a bit better money, and you look at the amount of tax you're paying. Like, damn, man, I need to think about how I can optimize this a little bit, how I can be a bit more tax efficient. But then you're not kind of saving for, like, by that stage, right, average home ownership rates, I think the number now is like 36. And so, yeah, by 35 to 40, for argument's sake, most people have kind of made a lot of those significant purchases in their life. They've probably done the travel, might be settled down, and might think about kids. And that's when they're really kind of locking into, how can I create some financial freedom for myself when I retire? Like, at 35 to 45, you're within a 15 to 20 year window, and it starts to, I guess, come into the view. I haven't hit 35 yet, so I'm speculating. But what are the benefits of diversifying into crypto with your self-managed super fund? Like, why would you consider this asset class?
Growth potential, I would say. Crypto's got strong long-term performance, we should say, but also diversification, as I mentioned before. Crypto kind of behaves differently from shares or bonds. So by adding a small allocation, again, not financial advice, but adding a small allocation of digital assets into a portfolio, trustees feel they can balance their overall risk, especially if other markets are kind of flat or declining, And there's also tax advantages as well. Crypto inside an SMSF sits within the superannuation structure, but it benefits from those concessional tax rates, which is generally 15% in the accumulation phase and potentially 0 when it comes to that pension phase. So that's a far more tax efficient. It's far more tax efficient than holding crypto in a personal account, you could say. So, some people are clocking onto that.
Yeah, let's dive into those tax efficiencies a little bit deeper. Can you kind of walk us through step by step, say, a comparison between holding crypto in your personal name and putting crypto in your self-managed super fund, and how the kind of tax rates vary there? And I don't expect you to do the numbers in your head off the top of your head, unless you've got something in front of you. But, what is the difference there in long-term tax performance? Walk us through that step by step, the difference between crypto held in your personal name and crypto held in an SMSF from a tax perspective.
Yeah, absolutely. And, being on the front line with, crypto tax, certainly picked up a few things. SMSFs, they are great for tax efficiency. So provided you're compliant with the ATO rules, which can be quite strict. So the income inside the income inside the fund is taxed at 15% in the accumulation phase, and assets held over 1 year get a 1/3 CGT discount. So your capital gains discount is a third, and that brings the tax rate down to an effective rate of around 10%. So in your pension phase, when it comes to wrapping things up, earnings and gains, they can be completely tax-free at the end of it, up to $2 million Australian dollars per member. So you can You can also make before tax contributions as well. I think it's currently up to around $30,000 per year, which are taxed at only 15%. So it's something you can add to as you go. I think it's fair to say, again, not financial advice, but I think it's an effective way to grow your savings and lower your taxable income. It seems like a tax efficient way of doing that.
Yeah. And so just to read that back to you, as you're contributing assets to your self-managed super fund, when you're making those initial buys, in the same way that you're buying in your personal name, there's no tax there unless you're trading between assets. And actually, let's come back to that. Let's ask that question now. Let's say that you're trading between assets in your self-managed super fund. So let's say you start off as an ETH maxi and you think the ticker is ETH and you drop a whole bunch of ETH in your self-managed super fund. And then you decide, I'm going to be a Bitcoin maximalist instead. And you want to trade those funds from ETH to Bitcoin. Does that trigger a taxable event in your self-managed super fund or not?
That's a really good question. Actually, the ATO rules on this are quite strict. So as a trustee, you're fully legally responsible for compliance, and you have to meet the sole purpose test. So the actual assets in the SMSF are only for your retirement benefits. So there's a few things you need to do to stay tight on the requirements, just to make sure you're ticking all the boxes. And one of those things is you can't have your personal crypto funds mixed in. You've got to have a documented investment strategy. So you've got goals, your risk, diversification, your liquidity. It needs to all be reviewed regularly. There needs to be an annual audit as well. But if it comes to actually mixing in your cryptos together, then you need to be mindful of the ATO rules on the contributions, the withdrawals, and the valuations. And this is something you'd probably want to speak to a certified tax professional to be absolutely, tight on, because with non-compliance, if, for example, if you were to mix in your personal crypto and it all gets mixed together, you're using your personal wallets to move crypto in and out, then, there are, you could have a loss of the tax concessions completely. And then your tax comes up to 45%. So for non-compliance, you really got to make sure that you're following the rules.
What about a trade within your self-managed super fund? So let's say, you set up your SMSF, you have all your documents, you get your compliance right, and you buy ETH now, right? And let's say you leave that 10 years and then you decide that you want to pivot to Bitcoin, or you might pivot out of crypto entirely. You might sell that ETH allocation and move into gold, for example. If you are reallocating within your self-managed super fund, is that going to trigger a taxable event or not?
I'll be honest with you on that one. I don't know the answer to that question. Yeah. So
let's look at that. If our users know and have a good link to something that ATO has given as guidance or some articles about, please drop it in, because I would love to know that. So let's walk through that scenario again from the start, just so we understand. You buy Bitcoin in your self-managed super fund, you set it up. That initial buy is not taxable. Of course, in the same way that if you buy Bitcoin with fiat, it's not taxable in your personal name or in trust. A buy is not a taxable event from fiat to crypto or fiat to Bitcoin in this example. You hold that Bitcoin for 20 years and then it appreciates nicely at a CAGR of 29%, or what was Saylor's recent one, 21% to 21 million. And then you go to draw down on that in your retirement. For each of those drawdowns in that example before, you might be paying a taxable rate of around a tax rate of around 10%, compared to as a individual, if you were to hold that in your personal name and then draw down on that, sell it to fund your retirement, you might be paying a much higher tax rate as an individual. That's a fair kind of summary, I guess, of the strategy here from a tax perspective as to why you would put Bitcoin into your self-managed super fund. Bang on.
Yeah, that's absolutely right. Yeah.
Cool. Let's talk risks. What are the risks of putting crypto in your super? What should you be considering to the downside?
Well, I mean, there's volatility, of course. Prices can swing, as we know, 20% plus minus in a week. It's not ideal for retirement planning, and there's another thing you need to consider as well, is security. You've got to manage your private keys, and avoiding scams is critical. And then liquidity. It can be hard to sell quickly in thin markets sometimes. Another risk, as we've kind of touched upon, is the compliance aspect. The ATO can be pretty strict. So, if you breach the rules when it comes to record keeping, the asset valuation, ownership, your fund can lose its concessional tax status, as we mentioned before. And if that happens, then that can have serious consequences for your tax bill. So there's quite a few things you've got to consider. But yeah, I mean, it's one of those things. You got to make sure you're covering all this.
Yeah, absolutely. And I think when we look at crypto performance over the last 10 to 15 years, that top 10 by market cap has changed quite a lot, with the exception of Bitcoin, which of course has always been the leader. And so, the further out on the risk profile you go within crypto specifically, with a long-term vision, as a 20, 30-year-old looking out 40 years, might be incredibly difficult to pick what might still be a strong performing asset in 30 years, for example, in such a new space and such an emerging space. The other thing, which I think is an interesting and important call out, comes off the back of the discussion in Australia recently about taxing unrealized gains on super, is that I guess you are locking into that investment vehicle if you do choose to allocate funds to a self-managed super fund. As far as I understand, it's very difficult to withdraw from that, right? It's designed to be your retirement fund. You're not supposed to be trading in and out of it to buy a Land Cruiser, COVID. But you're not necessarily going to be able to move those funds out if that suddenly does not become the most tax efficient vehicle. And so keeping in mind that both compliance and I guess you call that jurisdictional risk or investment vehicle risk, when you start to look over the period of 20, 30 years, there's something to consider there as well. And so I guess, you're back to the old adage of, diversification, both of, the assets that you look at, that you consider, and also of the, the vehicles that you choose to use. What about, or anything to add to that?
No, absolutely right. Bang on.
What about the ATO requirements for a self-managed super fund? And I think the question a lot of people would have as well is how much do these cost to set up and run?
Yeah, good question. I mean, but the ATO rules are, like we said, fairly strict. You got to meet the sole purpose test, and that's just confirming to the ATO that it's only for retirement benefits completely. And then there needs to be also a documented investment strategy in place that covers off your goals, that considers the risk, the diversification, the liquidity involved. And I think, as I mentioned before, it does need to be reviewed regularly. There's an annual audit that needs to happen. It's required by an ASIC registered auditor as well. And you've got to keep the records as well. This is really important. Keeping your records, your minutes, statements, transactions as well. Your history needs to be complete up to 10 years sometimes. It's important as well to stay on top of the ATO rules in terms of contributions. Withdrawals and your valuations, it all needs to be accounted for. But in terms of cost, I guess that comes on a case-by-case basis. You have to speak to a certified tax professional to make sure you're fully aware of the expenses going in.
Yeah, and there's obviously, wherever there's compliance, there's expenses too. Absolutely, this is super loose, but I think I've heard people talk about a very rough cost of $2,000 to $3,000 Aussie a year to set up and maintain a self-managed super fund. And the cost primarily comes from obviously setting that up and having the kind of compliance support from accountants, etc., to set that up. I would be super interested to run a side-by-side scenario comparing at what point that's more efficient than, say, fees in a super fund. But that can be a task for somebody else. I probably don't have time to do that right now. So if anybody does want to have a crack at that, please share it back with me. Let me know. What about accountants and auditors? How do they view crypto assets and in self-managed super funds? Are they comfortable with verifying them? How are they treating these assets?
I think it's fair to say many are becoming familiar, but they're still cautious. There's still a caution in the air. Crypto introduces challenges around proof of ownership, for one, and then valuations and record keeping as well. And then we've got traditional assets, the simple registries, statements, crypto requires your wallet addresses, your full transaction history. So if records are messy, you've got multiple wallets using various exchanges, you've got missing data, auditors can refuse to sign off. So the best practice is to use a compliant Australian exchange, keep your records tidy, and use a dedicated tax software like Koinly to track everything. And I'm happy to say that many accountants are already doing that. So that certainly helps.
Let's finish with a crypto SMSF myth. Bust one for us. What's your favorite?
Oh, good one. Probably the SMSFs let you avoid tax on crypto gains. I mean, it's not true at all. SMSFs, they do offer concessional rates, but the crypto inside your super fund is still fully taxable. So it's not a tax loophole. It's not a get out, for crypto, but it is about using the super system's existing rules to hold assets in a more tax efficient way. The same as you would with shares or property.
Absolutely. And it is definitely, an opportunity for tax optimization. And yeah, that was an awesome kind of run through of what actually is an SMSF and what are the tax implications of parking your funds there in crypto assets rather than holding them in your personal name if you're looking to retire off the back of those assets. That was awesome, Will. Now, obviously, Koinly is a leading crypto tax software, and you guys have got an active offer at the moment for our Binance users. Do you want to walk us through that quickly? What can our users get help with on Koinly?
Yeah, thanks so much. Thanks so much, Liam. Well, I mean, for any viewers that don't have a Koinly account, you can get 30% off before the 31st of October deadline by entering Binance AU 25. That's in caps, Binance AU 25 at checkout, and you'll get 30% off your first plan. So yeah, we can help sort of unify your data and help make things easier and help you sort out your crypto tax.
Yep, and I've been a Koinly user myself in the past. It's great software. It's a very, very good way to sort out your absolute mess of a degen trading strategy if you need help with that. Thanks so much, mate. Great to have you on the show, and we'll talk soon. Appreciate it.
Cheers, Liam. Thanks for having me.
Cool, guys. We've got a bunch coming up in the next couple of weeks. We've got some really good episodes, and I can't wait to share them out with you. So stay tuned, like, subscribe, and of course, if you're coming to Oz CryptoCon, I'm going to see you there. We've got a bunch of fun sessions. We're going to have Jack Robert coming along. I'll do Bitcoin versus property. We're going to have Richard Tang, Rachel Conlon, a absolute who's who of Binance. So come and find us there. There's a discount code in the notes as well. Until next time, Binanceans, catch ya and have a great week. Bye. Please note that this discussion includes insights from non-affiliated third parties and key opinion leaders. Binance provides this platform for informational and educational purposes only and is not responsible for any content or insights provided. This information should not be considered as financial, tax, or investment advice from Binance. DYOR Binanceans.